Hey everybody, I'm JC Parets. I'm the founder of allstarcharts.com and welcome to StockCharts here. I appreciate the invite. Shout out David Keller and everybody, all the folks over there. You know, when I first started doing this, they're like, JC, what do you want to talk about? I'm like, all right, three things. First of all, let's make sure there's a lesson on every episode, you know, something that we could take away. Let's talk about the market, obviously, and let's answer some questions, right? That's how I look at it. So that's what we've been doing. It's been fun. Thanks for all the feedback, for sure. All right, so today's lesson, I think it's important to be open-minded to where we get information. I was just having a conversation on Clubhouse. By the way, if you're on Clubhouse, make sure to follow me at All Star Charts every day at 11:30 a.m. Eastern time during the week. We do a Clubhouse, and today part of the conversation was like, "Hey, JC, like, you're looking at Indian stocks and Indian markets to use as information to make decisions in the U.S. Like, first of all, like, why do you do that? And can other investors do that? And is it for investment purposes or just for informational purposes?" And I thought that was a great question. India, for example, I'll give you a couple of examples, but in this case, Indian bank stocks throughout 2018 were very strong. Meanwhile, European banks and U.S. banks were falling. But that relative strength in Indian banks preceded what ended up being a very strong 2019. There was wisdom in the relative strength of Indian financials. Meanwhile, a year ago, when the S&P financials index, U.S. financials, and the European financials index made new highs into February of 2020, which is basically a year ago, actually. Yep, exactly a year ago. Indian banks were already rolling over, making lower highs. There was wisdom in the relative weakness of Indian banks, telling us, calling fugazi on these new highs that European and U.S. banks were making. Again, a strong signal on the opposite end. And then today, Bank Nifty is making new all-time highs. So what does that say about U.S. financials? What does that say about European financials? What does that say for risk in general? You want to know what the prettiest chart in the world is? Nifty Energy peaked in January of 2018, like a lot of things did, and since then has done nothing, has continued to press against those highs and just recently broke out. What does that say about the energy space in general, with oil making new recovery highs? We've been talking about this commodity super cycle. Nifty Energy breaking out of a multi-year base makes perfect sense to me. It's just a very clean level. Kind of like what transports looked like before they broke out. Actually, very similar to what transports look like. Now that I think about it, they kind of look exactly the same. And then to stay on that India theme, you want to know something? If you look at Nifty small caps relative to Nifty large caps, so essentially the ratio of Indian small caps to large caps, and overlay that going back decades, it moves with risk, right? Like that ratio peaked in January of 2018 when risk peaked all over the world. That ratio bottomed out last spring when the rest of the world bottomed out. There's wisdom in that ratio from a risk standpoint. So even if you're never going to trade Indian stocks, you're never going to go to India, you don't like Indian food, whatever it is, all of those things, you should change that, by the way. You should go party in India. You should eat plenty of Indian food, right? You need a series of good Indian friends that can tell you where the best restaurants are. Like, man, they do it right. And it's so much fun every time we go out to India. I always come back so inspired. I always learn so much every time I'm out there. When things get better, we're going to have a big party in Mumbai. So if you're out there, you're listening, we will be coming to a city near you, but most probably in Mumbai, and then maybe Goa, and have a cricket tournament on the beach in Goa. That's kind of what I'm thinking. So if you're down for that, stay in touch. Make sure you're on our list, the distribution list, and we'll let you know when that happens. But it'll be when things get better, of course. Bonds, and then this is the last point that I want to make before we move on to current markets, even though I guess that's current markets. Bonds. If you're never going to trade a bond, if bond ETFs bore you to death, fine. You don't have to trade bonds and bond ETFs. There's information there. Most recently, we were looking at the TLT at 155 and saying, hey, if bonds break out above 155, rates roll over, what are stocks most likely doing in that environment? And we were arguing they'd be lower. However, if bonds failed to get back above 155 and rolled over and interest rates spiked, what would the market environment do in that particular case? And we argued that stocks would be higher. Sure enough, stocks have done very well. So sure, we trade bond ETFs. We put on options trades on bonds all the time. But even more so than that, we use it as information. And it really, really, really helped us out. You guys who have been following along for a while know, when we talk about stocks, we're going to talk about bonds in that conversation, right? It's all part of the intermarket. I mean, this is StockCharts, right? John Murphy, that's where I got my, intermarket. I'm a Murphy disciple through and through, if you hadn't noticed. Okay, so lesson, there's information in other assets around the world, in other countries around the world. It's not just, hey, this head and shoulders, symmetrical triangle, diagonal, crossing donkey, whatever it is that they're calling the chart patterns these days. Okay, that's my lesson. I hope that you found that informative. And we'll take a look at a couple of these charts so you can see that. Most new highs ever. Most new highs ever. We've never had a time when we've seen more new highs. So anybody who has told you that market breadth is deteriorating is a fool. No, but was wrong, I should say. Probably not a fool, because we say incorrect things all the time. Foolish, let's just say. Foolish to say market breadth is deteriorating. That is just simply not the case. We're seeing more highs than ever before, right? Okay, let's talk about some of these defensive areas. Getting back to what we just discussed, that there's information in other asset class. If you never want to trade a consumer staple for the rest of your life, fine, don't. But there's information there. So if stocks are going to be under pressure, if stocks are going to be selling off, these lines are going to be going up. They're making new lows, which is consistent with an environment that stocks should be doing well. And sure enough, stocks have been doing fantastic, right? So if stocks are going to be selling off, you're going to see at least a relative bid in bonds. You're going to see a relative bid in staples, consumer staples, Coca-Cola. No matter how bad things get, we're still going to be smoking cigarettes and drinking beers, brushing our teeth, washing our dishes. Those are staples. Expect a bid there. Probably see some gold outperformance, not literally melting down. The new 52-week low list has been basically deserted. There's been nothing going on in the new 52-week low list. And now all these crappy gold miners breaking down to new lows. Look at the 6-month low list. Look at the, 52-week low list. And you're going to start seeing some miners popping up in there. That's really how bad those stocks have been. So needless to say, we're not seeing a relative bid there. Quite the opposite, literally crashing. The gold fund, GLD, has never been worth less relative to the NASDAQ 100. Man, it's never been worth less. Think about that. And then Aussie yen making new highs. So we're not seeing any bid in yen, any of these defensive areas. We're not seeing it at all. Credit spreads, new lows across the board, since the recovery. New lows across the board, narrow credit spreads. It's not about coronaviruses and, cases and deaths. It's not about that. It's about liquidity. It's about credit. And there's been plenty of liquidity, no stress in credit whatsoever. By the way, if you're interested in these slides, email info@allstarcharts.com and make sure you use the password bull market. I give a lot of presentations around the world, all sorts of asset classes and different things. You don't want to get the wrong slide deck. So make sure you use the password bull market. info@allstarcharts.com/bull market. Volatility fell to the lowest levels again since the recovery, essentially confirming what credit spreads are suggesting, right? New lows in credit, new lows in volatility, which again is man, if we're below 20, which we're currently not, as I'm recording this, it's right around 22 on the volatility index. If we break below 20 and are holding below 20, and we get that slow dribble down to the single digits, I mean, just think about what stocks are doing in that environment. I'd argue they're doing very well. Just a few sectors, just so you can see what's been going on out there, the type of buying. These are the places making new all-time highs: home construction, software, biotech, medical devices, cloud computing, online retail, all making new all-time highs. That's consistent with a strong market environment, obviously. Continuing with that breadth conversation on the advanced decliners, small caps, mid caps, large caps, across the board, new highs in the advanced decline line. So breadth is strong, internals are strong. The trend in stocks is up. The trend in defensive assets is down. That hasn't changed, right? This is one of the strongest markets of all time, no doubt about it. Checking in on the media. Let's see what the media is telling your parents. Let's see. This is Forbes. It's telling your parents, wondering if the stock market's going to crash. All right. We just had a crash a year ago. I guess they're already looking for another one. Seems a little antsy if you ask me. So I should be getting a call from my parents or my grandparents, about what the news is telling them. Let's see, what else are these news people telling your parents? Warren Buffett's favorite indicator, right? This dude said something about this ratio once, and he's never been able to live it down, right? He said that it was total market cap relative to GDP was like a signal he liked, like in the 90s or something, before I could even drive. And he hasn't mentioned it since, but the media, holds him to it. So I guess this ratio from 30 years ago is high, so the media thinks it's a big deal. Charlie Munger knocked that down. He said, just because Warren thought something 20 years ago doesn't mean it's a law of nature, between total market cap and GDP. There's no automatic correlation between those two figures. So we could just, and by the way, Charlie Munger didn't just say this. He said that years ago, and yet they continue with Warren Buffett's favorite indicator. Like, they're so full of shit. Like, are you kidding me? Like, leave it alone. Like, why do you have to be so dramatic about it? Like, the perma bears and the journalists care more about Warren Buffett's favorite valuation metric than Warren Buffett does. I just think that's hysterical. All right, so, pattern recognition. This is how I look at it. We're talking about technology on a relative basis, and the target has been those former highs from back in March of 2000, which we are nowhere near. We still have a long way to go. You want to know what the bear case is that this is not a bull flag, right? That's the bear case. The bear case is that this consolidation is going to resolve down, right? Which I would argue would be negative for the market, at least temporarily, right? If that happens, we're talking about a quarter of the entire S&P basically, right? Or almost. That's a big chunk. So I think the market's going to have a hard time going higher if this resolves lower. If this is a bull flag, then, expect stocks to continue to rip. By the way, there could be a lot of stocks doing well, like financials and energy, going up and doing really well, and technology and some of these mega caps just drag down the indexes. That's possible too. So keep that in mind, and we'll get into financials and energy in a minute. Look at technology relative to the Nasdaq. People forget that the Nasdaq is not tech. Like, that's just not true. There's a lot of different industry groups. It's everything except for financials. Technically, if you look at what the definition is of if you look at what the definition is of the Nasdaq 100 or the Nasdaq stocks, it's the non-financials for the QQQ. And now just take a look at this. Look at this. So this is tech relative to the rest of the Nasdaq 100. Support in 2011. This broke in 2013. We got back there a year ago and failed, right? We were writing about it at the time. It was part of the reason we were so bearish of tech. And on a relative basis, we just broke down to new lows, quickly got back above it. So if we're above those former lows from last year in tech relative to the Nasdaq, look for tech to outperform. Look for this chart to break out most likely also, right? So that's a really, really interesting sort of dynamic going on in the market right now, whether tech's going to start to outperform again, or whether they're going to roll over, which is going to hurt the market. That's that case. Semiconductors don't care what the hell is going on with the rest of tech. We've seen some, churning in software and cloud computing and some of the other internet, some of the mega caps for sure, some of the other areas of technology. Semiconductors don't care. They just keep ripping new highs on a relative basis across the board. And by the way, I think we get back to those former highs, which is part of the reason why I think tech in general gets back to those former highs, right? That's how I look at that. Interesting stocks here. This is on semiconductor. You guys following along, remember, this is where we were buying it last year. Boy, did that work out. You guys that are always wondering why I'm talking about these big bases, this is why. You see these big bases, that's why we look for them, because this is the sort of thing that happens, right? So our target was 38. That target was hit. We churned for about a month or so, acknowledged that level. Demand was able to absorb any supply that was there, and now we're moving on. So if on semiconductors above 38, we want to be long with a target of 56. Look at KLAC's $51 billion semi. If we're above 303, I like this long with a target up near 500. And Palo Alto, if we're above 353, I like PANW long with a target of 504. 504 boys. Anybody remember that rap band, the 504 boys? Am I saying that right? If I'm not, I'm embarrassing myself. I'm sorry. It was a long time ago that we were listening to somebody called it 504 boys. I think it's New Orleans, if I have that right. Anyway, NVIDIA, also in the software space, also a young aristocrat, which, if you guys recall, are what we think might be the future aristocrats. Aristocrats have raised their dividends every year for 25 straight years. So we try to stay one step ahead of the curve. We're looking at what we refer to as the young aristocrats, which have consistently raised their dividends every year for between 5 and 9 years. Those challengers, if you will, to be aristocrats one day. Very low payout ratio, less than 12%, which is the amount of their earnings that they pay out, which is very low. 8 consecutive years of dividend growth. Many people didn't even know NVIDIA was a dividend name. I know I was surprised when I first learned of this, but it's been one of our favorites. Partly not, the fact that it has a dividend is one of the reasons it was on our radar, but this is one of those names that would have been on our radar anyway, right? That scan is to sort of identify names that we're not already looking. NVIDIA pops up on a lot of our scans for obvious reasons, because we sort our scans by proximity to new highs, and this sucker keeps doing that. So anyway, 565 on the NVIDIA. If we're above that, I like it long with a target of 837. And we like the options trade here, bull call spread. Long the September 640 calls, short the September 660 calls. Bull call spread on NVIDIA. And then this is what I was talking about, guys. So this is Nifty Energy. So this is in India. Just look where risk peaked in 2018, has gone nowhere for a couple of years and just broke out. This is really interesting. And just look at the size of this base. We're just talking about how much I love these bases. Look at that. Monster base, breaking out to new all-time highs. It's hard for me to ignore that. When I look at this, it's really, really hard to ignore that. Let's see. All right, so Chevron, how are we going to take advantage of energy? So if we're going to do, by the way, I hear Warren Buffett is getting very aggressively long Chevron. That's probably not a bad sign. We have these scans that we run that we look through 13Ds, 13Fs. In the case of Warren Buffett, it's typically a 13F because he owns, he's more of a passive guy, not active like a 13D. We're analyzing the Form 4s, which are the insider transactions, insiders in companies, and whether they're buying or not, what they're buying, how much, and the congressionals. Like Nancy Pelosi the other day was YOLOing Tesla calls. I think she bought a bunch of Tesla Leaps. Right? So that's information. They're allowed to do that, but they have to file. So Chevron, we want to be long CVX if we're above 50. If CVX is below 50, leave it alone. Sorry, not Chevron. This is ExxonMobil. I'm sorry. This is Exxon. Chevron is next. But let's finish with Exxon. $50 on the XOM. XOM. If we're above 50, we want to be long with a target of 66. Right? So if we're above 55, if ExxonMobil is above 50, we want to be long with a target of 66, which is all that support from the last couple of years, right? So that former support should turn into some resistance, at least temporarily, but temporarily enough that we don't want to be in it when we get there. So we want to be buying this breakout. ExxonMobil long if we're above 50 with a target of 66. And then here's that Chevron trade, 96 on the Chevron. If Chevron CVX is above 96, we want to be long with a target of 123. So long Chevron CVX above 96, only if we're above 96. Below that, leave it alone with a target of 123. On the option side, the September 100-115 bull call spread. So keep that in mind. We are, let me just pull this up. So CVX, just so that I can get it right for you guys. So CVX 100-115 bull call spread for approximately $4.30. That means we're going to be long the 100 strike and short an equal amount of the 115 calls. So we're going to be long 100 strike calls and short an equal amount of the 115 calls for a net debit. So these are the September contracts for a net debit of $4.30, which represents the most we can possibly lose on the bull call spread. Just from a pure equity standpoint, 96 is the risk level. If we're above 96, we want to be long with a target of 123. And you can go to allstarcharts.com for the details and the risk management procedures. We don't just throw trades on and hope for the best. There are risk management procedures in there for sure. And if you are interested, like I said, in the slides, make sure to email info@allstarcharts.com and make sure to use the password bull market, because if you don't use the password bull market, then you're going to probably get the wrong presentation. It's happened before, and it'll most likely happen again because some people don't like to listen. You know how that is. I don't like to listen myself. So, all right, let's take some questions. So we had a lesson, right? Look for information elsewhere. We talked about bonds. We talked about India. You know, you could look at like something like a Freeport-McMoRan is great information about, you know, base metals, Latin America. You can look at Latin America for information about base metals and global growth and things like that. Australian dollar, you know, shares of Caterpillar, copper, emerging markets, like that theme. You know, there's information from these different asset classes. Okay, so JC, if the Fed prints more money, is that going to help the market? I don't really know anything about that stuff. Like, I understand in terms of quote unquote Fed printing, like JP Morgan's not going to take that money and go buy Tesla, right? So when they say that like these stocks are up, because that doesn't work that way. So I'd worry less about the Fed printing, and I'd worry more about the direction of price, because any impact that Fed is going to have on the market is going to be priced into the market. And later on, you're going to find out, oh yeah, because of the Fed printing or whatever it is, whatever story you want to tell yourself to justify what price is doing. We don't necessarily care why price is doing what it's doing. If the Fed is buying bonds, if the Fed is selling bonds, first of all, they're telling you what they're doing. Second of all, the Fed is a market participant as well, right? You might not like that the Fed is buying bonds. You might not like that. That might upset you. You might be philosophically opposed to the Fed buying bonds. You might think it's communism. Like, you could think all these things, but it doesn't matter what you think. Like, nobody cares what you think. Certainly not the Federal Reserve. Certainly not the market. So it's not about what you think or why, right? None of that matters, right? I have my opinions. Nobody cares, right? It's price is the only thing that pays. That's it. Doesn't matter what we think. Price pays. And if you think that the Fed printing is good or bad or whatever it is, or the market will tell us whether it's good or bad, right? And that's what's important. So as a follow-up, if the Fed is printing money, why isn't gold going up? Because nobody wants these rocks. Nobody wants these rocks, right? Nobody wants them. Nobody needs them, right? And it's like, well, JC, I would rather own rocks than own the NASDAQ 100, growth companies that are revolutionizing the way we live. I'd rather own rocks. You are welcome to do that, right? I'm not your therapist. I can't help you. If that's what you wanted to do, that, and then, I get the people, well, JC, it's been around for 3,000 years. Well, I haven't been around for 3,000 years. You might have been, gold might have been. I have no idea. Like, how is that even relevant, right? People are like, well, JC, it's because of the Bitcoin. People are buying Bitcoin and not gold. That might be part of it. I don't think it's a huge part of it. I think it could be a small part of it or some part of it, but I don't necessarily think that Bitcoin's at the point where it's taking all this market share from gold. Like, I'm just not there yet. Or it's not me. I don't think that Bitcoin is at that market cap level yet where it can have such a dramatic impact. Some, sure. But that dramatic, I don't think so. I think it really has to do with the fact that people just don't need rocks. Like, why would you put money in rocks? Because, too much risk in stocks. You're not getting paid elsewhere, so you just wanted to hide in a bunch of rocks, right? Like, we're not in the type of environment where people want to do that, right? That's really the key here. So it's being reflected in price. Now, let's rewind. When did it start getting reflected in price? When it got back to those highs from 10 years ago, right? Gold peaked in 2011. We just got back there in August, right? Which is why that was our target, right? We were super bullish gold, by the way. I'm not like Mr. like gold hater. I really don't care. Like, gold can triple from here. It can go to zero. It's not my problem, right? That's not my problem at all. It doesn't matter to me. But we were super bullish because gold was in an uptrend, and we had a very clean target. The former highs, right? It doesn't get cleaner than that. We hit the former highs, you feed the ducks, and you move on to something else. And I don't know if you noticed, there have been plenty of great things to be buying since the end of August, early September, when gold hit our target. And gold's been the worst trade in the world. The worst. I think maybe bonds might be the worst trade in the world. It's neck and neck, right? Neck and neck between bonds and gold is the worst trades on planet Earth. But needless to say, it's being reflected in price. Not to mention that of all the commodities are doing great. Energy is doing fantastic. The ags, base metals, all making new highs across the board. Gold is not. So what does that say for risk? Is that market participants want to be in all the commodities except for gold. I'd argue that's just bullish for risk. That is likely to happen in an environment that stocks are doing well. And sure enough, stocks are doing fantastic, right? So it makes sense. It's when you start to see that relative rotation into precious metals and out of stocks, that more defensive move, that's information. Again, whether you're ever going to trade gold or not, at least there's information there. And the information that it's giving us as gold miners break down, pushing down near 52-week lows. I mean, man, like gold miners are like the only stocks that are making new lows. Like no other stocks anywhere in the world. Like go look. I have, but I encourage you to go look. You're not going to find any other stocks. The only ones making new lows are gold. Nobody wants them. Nobody wants the rocks. And it's not JC's fault that nobody wants the rocks. It's not, StockCharts' fault, right? Nobody wants them. It's just what it is, right? Maybe one day they will. I don't know. We'll be watching. We'll be waiting. I'm all for buying them. It's just as they're making new lows. As I learned it from the great Luis Yamada, is that bottom fishing can be very hazardous to your wealth, right? That's how I learned it. So we're just not there yet. Leave it alone. And by the way, the only reason why we're not short gold is because silver keeps outperforming. And that has me curious, right? So while we're certainly not long gold, and we don't have any interest in being long gold, at least not yet, the reason we're not short, for those of you wondering, like, oh, JC's such a hater, why isn't he short? Is because silver's outperforming. And silver outperforming gold is not the type of environment where I like being short precious metals. It's just not. So I'd rather just not be in it and use it as information for making decisions in other places, right? I think that's the key. Speaking of which, I didn't even do that on purpose. But speaking of getting information in other places. And then finally, third question, is this a real breakout in financials? I think you got to call it that. If we're above 31, that's my level. If the XLF is above 31, how do we not call it a breakout, right? And by the way, JP Morgan's right there. JP Morgan, if we're above 141 on JPM, I think you can own it with a target of 180. If financials are above the 07 highs, $31, XLF, I think you can own it. Be careful with that dividend adjusted stuff. Some websites like to, do dividend adjusted. Also, different data providers. Be careful with that because, they spun off the REITs. REITs used to be in the XLF. So make sure you're getting the price. Make sure your charts are clean. You should have a flat top at 31 going back to 2007 that was retested 4 or 5 times since then. And if you're not getting that, check your data source because we've had some confusion with that. So flat top. Right around 31 on the XLF. If it doesn't look like that, check your settings, check your data provider, et cetera, or just reach out to me and we're happy to help you out as best we can. Again, if you're interested in the charts that we talked about today, email info@allstarcharts.com, password bull market, and send in your questions. What should we talk about? Right, we're going to do this every week. You're stuck with me, whether you like it or not. So we might as well take some, answer some of your questions. And, guys, just in general, just a last thought. Stay open-minded about everything. I'm talking, we had some caviar the other day, right? I got my hands on one of those little cans. Expensive as hell, those things. And I'm giving it to my mother-in-law. She's like, oh, I don't like caviar. And I'm like, when was the last time you had it? She's like, I've never had it. It's like, how do you know you don't like caviar if you've never tried it, right? Like, hello, have an open mind. It seems silly not to. Same thing in the market. Anything can happen. The market doesn't care what you or I think. We can be pounding the table on something. The market doesn't care. So let's be open-minded on the possibility that we could get it wrong and just keep reevaluating that every day. All right, guys. Thanks.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.